Appreciate it. Hello, everyone, and welcome. I'm super excited to see everyone this morning. And great way to, like the fact that you guys are here on the Friday of a long weekend and want to share it with us. That is so awesome. Really appreciate that. So we wanted to give you some really, really cool content to be able to get y'all pumped up to head into the weekend. And, it's interesting because we're going to talk a little bit about reverse mortgages. And a lot of people, one, have a lot of negative connotation around what a reverse mortgage is, and two, may not see how a reverse mortgage can help you actually drive more business results. So that's what we're going to share with you guys today. I've got Corey here with us. Corey is the newest member of Steph and I's In Debt on Purpose team, and we're super excited to have him be joining us. I know he's been a part of a couple of our calls, and we just want to be able to make sure he's got a face and name coming out to you guys, and he's providing a lot of support for us today. So Steph is currently just finishing up her backpacking in Austria, so she is not able to join us this morning. So you've got just the Christina and Corey show this morning. All right. Okay, so we're going to get started. I'm going to do a share screen here, and we are going to get underway. Give me a second here. And if you can just somebody give me a nod that we can see the share screen. Fantastic. Awesome. Get right back. There we are. Got to start at the beginning. Okay, so when it comes to real estate, the greatest amount of home equity that exists out there right now, that wealth lies with our 65 plus homeowner generation. So that's like a lot of untapped. And I think with COVID and everything that happened during that time frame, a lot of people realized that they kind of wanted to be able to age in place. And so, maybe they're not selling their properties and downsizing quite the same, creating that inventory in the market. And that's a lot of equity that is just sitting around there. So we want to just talk a little bit about how reverse mortgage options can help you be able to create more opportunities to do more deals in today's market with that, with those folks, right? But before we get into that piece of it on how it creates opportunities, we want to just do a quick review on what a reverse mortgage is. Okay. Mortgage basics about the reverse mortgage options. So what probably most of us know is that, there is no payment that is required with a reverse mortgage, right? So when they get the reverse mortgage, they get, a principal amount advanced, or they can choose like a principal and a principal lump sum amount to be advanced and then take an income draw, and no payments are required until they either, pass away and the property is sold and the debt's paid off, or if they actually choose to sell that property, right? And then that mortgage has to be paid off because the security is now gone from it. From a qualification standpoint of view, this is a really great product because most often folks in that 65 plus are technically we can do as early as 55, they're retired and they don't have the same level of income that they used to have to be able to qualify for mortgage financing, right? So very limited credit and income requirements, no medical checks or anything like that that's required in order to be able to get this financing. But the ability to unlock up to 55% of their home equity is truly dependent on the age, the gender, believe it or not, the property location, the type of property, and the property value. So it will vary from individual to individual how much we will actually be able to provide. The older they are, the more access to that equity that they're going to be able to tap into, okay? Funds can be advanced as needed, or with the interest only incurring on what is actually been advanced. So if our clients were to take, a small lump sum to start, and then they want an income draw to supplement their living, they're not paying on the interest on the full approved amount. They're just paying interest on those draws along the way. The beautiful thing is that these proceeds that they receive are tax-free. This is not declared as income anywhere. So it does not affect their OAS clawback. It does not affect if they were getting the GIS, the Guaranteed Income Supplement funds, right? It doesn't affect anything from a pension standpoint of view. So it's really, really good access to money without having that financial tax implication, okay? Penalties are also waived at death. So like a traditional mortgage, when you enter into a reverse mortgage contract, you're choosing between a 1 to 5 year term option for your mortgage, and you would experience renewals just like a standard mortgage. Really, the only thing that's different is that you're not making payments on it, okay? If you were to break a mortgage contract in the traditional sense, there would be a penalty that would be associated with breaking that mortgage, which is the same if you just sold the property with a reverse mortgage on it and you hadn't met the end of your contract time frame, there would be a penalty associated with it. But if the reason for the sale is the passing of the owner, then those penalties are waived. Okay, so they don't penalize them for passing away, which is great. But here's another cool thing. Did you know that with a reverse mortgage, if one spouse passes away, the surviving spouse does not have to requalify to carry the debt in just their name alone? So you think about a traditional mortgage that they had where they were making payments on it. They can't renew that mortgage without the signature of the other spouse who's just passed away. So that's physically impossible. So what happens is they go into the financial institution, they have to requalify, they're now a sole income, and they can't be able to do that, right? So this is just a really great way to be able to have a surviving spouse be able to maintain their standard of living and not have to be living in fear that they wouldn't be able to qualify to carry that mortgage on their own, because there's no payments and there's no requirement to be able to have them requalify for that financing. All right, a lot of myths around the reverse mortgages. Some people think the bank owns their home. They do not lose title to that home. The title ownership always remains. The bank cannot force them to sell or foreclose on their property, okay? So the only real criteria that they have is that they maintain their property taxes up to date. That's it. And so they won't at any time call, like if the markets were to crash, they're not going to reevaluate their home. They're not going to demand that they make a lump sum payment to bring it in line. They're not going to do any of that, okay? The other concern that a lot of people have is this debt is going to continue to accumulate with the interest. What happens if I owe more than the house value? Well, the strategy behind the reverse mortgage is to cap at 55% of the value of the home. And so that's very conservative. As the debt itself continues to accumulate interest, what happens to property values, right? Property values are going to appreciate as well. So you've got the debt appreciating, but you also have the value of the home appreciating. And the value of the home as a much larger limit, right? And so the value of the home is going to appreciate at a faster rate than what the debt itself is appreciating at. And so there's always that buffer of equity that typically happens in there. However, if for whatever crazy reason the market actually collapsed, property values plummeted, and they had to sell the home, whether they passed or they were actually selling the home, there is no negative impact to that homeowner. So if that property was sold and there was still $50,000 outstanding, $100,000 outstanding, does not matter. That balance is not payable. Okay, they will never ask for more than what the property value is. Now, property values were way up there and their debt balance is. When that property sells, they pay off like a standard mortgage, the principal and the accumulated interest. The rest of it is equity left over that goes to the owner or the owner's estate. Okay. And reverse mortgages aren't a lender of last resort. There's a lot of opportunities, and we're going to dive into those to show you how a reverse mortgage can actually create additional financial wealth for our homeowners. So most people are used to thinking about reverse mortgages in the most traditional way. And here's the perfect scenario that shows a standard reverse mortgage scenario. They have a client, 72 years old, struggling with being able to keep up with their bills due to high inflation, right? All our costs of gas, groceries, everything is going up. Pension income and old age security are pretty standard and fixed. So with all these price increases, she was just feeling the financial stress and pressure, right? Thought that she might have to move. So the home value that she had was appraised at 1.2 million, and she only had $100,000 of mortgage left on it. So with one of the reverse mortgage products called an income advantage, she accessed $125,000 of equity from the home to start. That $125,000 paid off the $100,000 mortgage plus $25,000 in some debt consolidation that she wanted to be able to do, right? But she also wanted to increase her monthly income because that $2,800 a month in pension and OAS income that she was receiving just wasn't enough to be able to fund all the bills. So she started taking a draw of $1,200 per month to give better improved cash flow. So now she's receiving $4,000 a month in income, right? And I want to qualify, only the $2,800 is income. The money coming from the reverse mortgage is not income, but she's receiving $4,000 a month in cash flow and does not carry a mortgage payment. So now all of a sudden that really changes the standard of living, right? So let's look at what that impact is. The house is worth 1.2 million. She's taken a lump sum of $125,000 on the reverse mortgage. The equity position in the home, if she were to sell it, basically is 1.75 million, right? Or sorry, a million and 75,000. In 10 years, assuming I think it's a 4% appreciation rate per year, that home value is going to be worth 1.77 million, right? The reverse mortgage, because she's doing the $1,200 draw per month, on top of that 125,000, is she's going to pull $269,000 in principal balance from the equity of the home. The accumulated interest over the 10 years is going to be $208,000. So the net equity position after a 10-year time frame is still almost 1.3 million. You can see the equity position of the home is actually greater than where she started 10 years ago, and she's had the benefit of the draw of that income over those 10-year time frame. And so just to illustrate as a graph, the yellow line there is the reverse mortgage amount, so the initial 125, and then the continuous draw of the $1,200 a month, the interest accumulation as it's grown, and then the property value as it's grown, the dark blue being the equity still remaining in the home. So that covers the basics of how the reverse mortgage can work. Now, let's look at the scenario that creates buy and sell opportunities. How can you benefit by having this knowledge and supporting your homeowners in the marketplace? So here's a great scenario of where a reverse mortgage is used for clients that actually want to upgrade. So here's a situation where a 72-year-old couple with a 1.5 million home, older style house in Toronto, and they found themselves increasingly unhappy living in a rundown home that needed regular costly repairs. So we all know that there's a cost to home ownership, right? We've got regular maintenance and things, especially if they've lived there for 30, 40 years, right? They don't want to downsize, but they wish they could afford a house of the same size to be able to live in and not worry about things breaking down. The challenge is that they don't have that income to be able to qualify to actually upsize their home for their traditional financing. So by using a chip reverse mortgage, they were able to purchase now a $2 million home in their neighborhood without the income requirements. So they sold their existing home for the 1.5 million. They put a $500,000 mortgage, reverse mortgage on their new home of $2 million, and they have no mortgage payment. So here's an opportunity where you would have seen a client that says, I'm not going to move. I can't move because I can't afford to. So here's a sell opportunity for the existing home of 1.5 million, and now a buy opportunity for that $2 million home that they thought they couldn't afford. Now they don't have the costly repairs because they upgraded to a nicer home. maybe it's a little bit newer, maybe it's adapted to their ability to age in place and not have to worry about, the home no longer fitting their needs. We've all heard the bank of mom and dad. Maybe you've got buyers that are either first-time home buyers or upgrade buyers, and they want to be able to purchase maybe in a neighborhood that's a little bit more desirable, but it's a little bit more expensive. How about we explore, the bank of mom and dad, right? And this is where that 55 plus generation with all that equity in their home, how can they leverage that without a financial impact to support their kids, right? Mr. and Mrs. Patel, savvy Canadians who own a home, have a modest investment portfolio and pension to support their retirement. Children are fully grown. Their son is engaged to be married, and their daughter just had their first baby. They really want to be able to support those kids. They understood the difficulty of entering in the real estate market in today's environment, and they want to be able to help support them. The financial advisor let them know that drawing down on their investments at this time, because the market conditions weren't all that great, that it wouldn't be advisable to redeem out of their investment portfolio. So they decided to access the tax-free cash from their home with a chip reverse mortgage. So I just want to highlight, pulling money from RSPs, that income is 100% taxed. So it has a cost to pulling money out, right? Stocks and mutual fund portfolios, there's capital gains that are going to be required to pay, and then you're now losing part of the asset that can no longer appreciate and grow in value. Bonds and GICs are 100% taxable for that interest earned, so you're not making much on them, and then you're liquidating that portfolio. And cash, you're just draining and depleting your supplies and resources if you ever needed access to it. So by accessing the equity in the home, no payments, no tax, and it's a way to be able to gift or provide early inheritance and watch your children be able to enjoy the benefits of that inheritance fund. So it can create generational wealth for the family. So think about this one, 65-year-old couple with a $2.5 million home in Toronto, free and clear. The son's 38 years old. He's planned a down payment cash of $100,000 to purchase $1 million townhome. And I apologize, this example is not truly accurate because you'd actually need $200,000 to buy $1 million home. So we're going to call this home 999. Parents decided to provide son an early inheritance of $200,000 to purchase a $1.5 million townhome. Oh, I forgot to update that to Toronto, instead to be closer to the grandkids. So assuming that individual, the son, would have $100,000 to buy that $1 million home, the future value of that $1 million home would be worth $1.48 million. Okay, that's over a 10-year time frame. But with the parents helping, their down payment's now $300,000, and they were able to buy closer to the parents to help them out as they age and allow the grandkids to be able to be closer to grandma and grandpa, right? So they bought a home worth $1.5 million. That 4% growth over the 10-year time frame is going to turn that property value into $2.2 million. So that's a gain of $740,000 over that time frame. You've just created massive wealth for those clients by doing this strategy. The interest accumulation from the reverse mortgage is $238,000. So if the kids wanted to pay that back towards the grandparents, they still have a net gain of $501,000 on the investment. Right? For the parents, that home was worth $2.5 million. They took $200,000 out to gift to their son. That property value, home equity was $2.3 million. In 10 years, that property is worth $3.7 million. That $200,000 that they borrowed is the principal amount. The $238,000 is the interest amount. Their net value of the home equity is $3.2 million. So they really haven't suffered, so to say, right? And they got to enjoy having 10 years of having their grandkids super close to them and create an awesome relationship. So now this enabled you to go from $1 million sale to a $1.5 million sale. How do those commissions sound? Right? Another scenario, bridge financing situation. So these are some of the short-term solutions that are available. Retired couple realizes that this is a great time to buy in a buyer's market, right? Right now, the prices are going to just start going up as more and more activity is there. They're not ready to downsize, but what happens if they actually look at getting into that home now, right? It's more advantageous to purchase at a lower price today than what the prices might be 18 months, 2 years, 5 years from now, right? They're not ready to sell. Maybe it's just a short-term transition. They want to buy now, but they don't want to sell their house in today's market. They want to wait till it heats up a little bit more. It's still sitting in the sidelines, and see if they can get more money for the value of their house now and maximize that spread, right? So with this situation, the couple had a $2.6 million property. They found the perfect downsize home for $1.1 million. They needed to act right away. So with the open mortgage, they were able to purchase that home, have no payments, and then 6 months later, when they sold that property at a much higher value for the original property that they were in, they were able to pay off that reverse mortgage with no penalty when the time was right. So they're still mortgage free. They're still good with their cash flow. You could also suggest if they wanted to keep the home and find a tenant for them to help subsidize some of those costs as well, allowing them to keep two appreciating assets. You can help them with finding a tenant in that home. So there's a ton of other opportunities. It really just requires a shift in mindset and how this can be used to create those opportunities now instead of later. So construction financing advance. So if they're building a property, maybe it's in their next home or a cottage property that they want to enjoy. If they want to be able to put down payments on a pre-construction new build, maybe there's a new condo area that they want to be able to buy in, not going to close for another 3 or 4 years, but they have those down payments that they need to be able to meet. Maybe because of their financial situation, they didn't think they had the income to qualify, and they went out and they got a private loan. Reverse mortgage can take that expensive private loan financing out and eliminate that payment for them. So there's so many different ways, but like I said, it's about that changing that mindset and the terminology around it. Proactive downsizing, right? Is that the new mindset that we want to be able to focus on? So here's that last example that we're going to go through. 65-year-old couple had a free and clear home worth $2.5 million. They're not ready to downsize yet. They had a son who was 40 years old and daughter 37, doctor and lawyer respective, great professions. They have $200,000 with an investment advisor. But because of the costs and everything that are associated with the rising cost of everything in today's market, they're really running a shortfall of about $2,500 a month. And the home that they're living in came with an unexpected repair, $25,000 of an expense that they had to spend. So what are their traditional options is that they could take from their investments, pull out $2,500 a month, which is about $30,000 a year, and have access to that one-time withdrawal of $25,000 to do the major repair that they had. The challenge with that is that their investment account will be depleted to zero sometime between the ages of 72 and 77. Then what do they do, right? They can reach out to their kids and ask for financial support, getting each kid to provide $1,000 a month to help them with their shortfall and split the cost of the $25,000 of the repair. But can your children really support you indefinitely? So they don't want to downsize today, but eventually they'll have to due to the financial reasons and the increased cost of living. What can we do? Well, that $2.5 million home was free and clear. The value of that home with a 4% growth over a 10-year time frame means that the house would be worth $3.75 million. So if today we released $825,000 in equity from that $2.5 million home, that allows them to be able to purchase a condo, $800,000, free and clear, plus the closing costs. They could rent that condo out for $3,500 a month, and they would net $2,500 in rental income after they've paid for the expenses of the property taxes and the condo fees, right? So they have no payments on that mortgage. The property sells for $3.75 million. The growth of that $825,000 mortgage over the time frame, they're going to still net $1.7 million in equity out of the sale of the home. The condo is going to continue to appreciate as well over the 10-year time frame. So it's now worth from $800,000 to $1.2 million, totally free and clear because we didn't put any financing on this condo property. They have that $1.75 million in cash from the sale of their home when they're ready to downsize and move into this condo property. Their investment portfolio that they now no longer had to liquidate was worth $300,000, from $200,000 to $300,000. And that's created $3.25 million in wealth, not including the $2,500 a month over the 10 years was $300,000 in rental income. That $2,500 a month was that $2,500 a month shortfall that they were having in their cash flow. So they used that rental income to subsidize that shortfall that they were experiencing, right? So really, really great scenarios of how we can be able to help clients. So in this particular scenario, you got the sale of a condo. Now you got the ability to be able to put a lease tenant in there, right? And then you take that one step further and help those lease tenants qualify on the tenant to buyer program. We can be able to just churn tenants through there as an income. And then your homeowners are going to be so grateful and loyal to you that they're definitely coming to you when they're ready to sell that property as well. So the opportunities are endless. So I want you to think right now, who do you know right now that's been missing out or sitting on the sidelines simply because they didn't think that it was doable, right? Who fits any of these examples or scenarios? I'd love to be able to open it up for anybody who has questions, but thanks so much for listening in, guys.
I'm sorry, I cannot put my hand up because I'm on the phone. Can I ask a couple of questions?
Yeah,
you sure
go
can.
ahead.
Thank you. First question is like if somebody decides to switch to regular mortgage, let's say they got that reverse mortgage and then maybe in 5 years they said, well, I want to go back to the mortgage pay, like regular mortgage. Is it possible?
Yeah.
And what does it cost? Like how do you cover that 5 year period?
Absolutely. Great question. So like a traditional mortgage option, at the end of their mortgage contract, the mortgage is fully open and no penalties, right? If you're switching midterm during the contract timeframe, like a traditional mortgage, you would pay a penalty to break the existing mortgage. As long as those clients financially qualified to be able to acquire a new mortgage, then those proceeds from that new mortgage can pay out the reverse mortgage, the principal amount they originally borrowed, plus the accumulated interest. No different than paying off a mortgage from another institution. It's just that you didn't have payments on that mortgage. It's a great question.
And the second question was, when the people get that reverse mortgage, can they use this money out of Canada buying some property, let's say in Dominican or Europe or somewhere else?
Yeah, absolutely. Great question, Anna. Honestly, the funds they're tax-free and they can be used for whatever you want. The only criteria is when you're setting up a reverse mortgage is the reverse mortgage has to be in first position. So if there is an existing mortgage on the property when they're applying to get the first mortgage, the proceeds have to pay out that first mortgage debt, any other debt that exists or registered on the property. And then any residual funds that are left over can be used any way that client sees fit. If the property is free and clear, they can take as much money as they can qualify for out of that property and use it any way they want.
So let's say, for example, if the mortgage is $300,000 at the property of $2 million, they have to apply and they want to get another extra $350,000. To get those, they have to get the $650 reverse mortgage in order to cover the existing mortgage, right?
Correct. Yes. Yeah. Yeah, absolutely.
Mm-hmm. And how do they qualify? Who decides like how much you can get from the home equity up to 55%? Like, is it based on your income or is it based on the age? Like, who decides that?
Yeah. Yeah, it's not income related at all. They do look to see that you have income, only to know that you can pay your daily cost of living expenses and keep your property taxes up to date. That's it. But the actual amount that they can qualify for against the property is based on their age, property location, and property value and the type of property that it is, right? So it's a little formula. So we plug all the information into the calculator, we do the postal code, the type of the property, the client's age, and then it'll tell us how much that we would be able to pull out as equity from that home.
Thank you.
You're welcome. So again, the older they are, the more access to the equity. So it goes up to 55%. But those of the younger age might see it closer around 30, 35%. The younger they are, right? It's not going to be fully maxed out at the 55%. Any other questions, guys? Awesome. Well, thank you so much for having us come out and chat about this. I hope it's opened up some eyes here on some opportunities where, people have said, oh, we're not ready to move. Gives you a bit of suggestions to be able to go out there and have some great conversations. Corey has kindly put our contact information into the chat there. Feel free to reach out. We're happy to be able to help. Happy Friday, happy long weekend, happy Canada Day.
Yeah. Sorry, sweetheart. So is it possible to organize like your meeting with a particular client if they have more questions?
Oh, absolutely. Absolutely. Yeah, we're always happy to help and have conversations with anybody who wants to be able to learn more. We're going to send out some marketing information for you guys as well, just some one-pagers on some of the summaries and examples that we shared today. So I'll send that out to Sarah to distribute to everybody out there as well. Thanks, SG.
That would be great. That would be great. Thank you so much.
Thank you.
You're welcome.